Welcome back, everybody. If you're new, my name's Nicholas, and this is Investing Against the Grain. We got a lot to talk about today. Today's Saturday. I wanted to get this out before next week, before the shareholder meeting, before we get more news with the macros and everything. I want to talk about where we've been, what has happened behind us, where we're going from a macro perspective, from our economy, from a world perspective, and most importantly, from a Tesla perspective. So, if you like this type of content, help us out, hit the like button, hit the subscribe button, ring that bell, and let's get into it. So to kick this off, let's take a look at Webull and let's see what happened with Tesla over the last week, and let's work backwards a little bit to understand where we were and how we got to where we are. And then I want to apply the macros onto this, and then after we've spoken about where we've been and where we are, we can talk about potentially prognosticating where we're going. Okay. Now, again, none of this financial advice. I'm an engineer. I try not to say just an engineer, but I'm an engineer who really has been in finance for a long time in my own personal way. I'm financially independent, so I'm doing something right, I would suppose, but I've been right lately. So I want to at least give you the insight into what I'm thinking is going to happen moving forward, and then you can make your own opinions about that. That's the biggest, I guess, not so secret thing about my success is that I listen to everyone and I just distill my own opinion about it. So that's what you should do. Listen to me, listen to other people, take all that information, and then you figure out what you think the real truth is. And from there, you can make your own decisions. So with all that said, let's get into Webull. So I'm going to share my screen now, and you guys should be able to see it. Perfect. I'm going to do my best not to block it this time. I don't know why. Sometimes when I'm sharing, I'm looking at it. My screen's down here for record. So I just, you kind of get a little messed up there. But we'll try not to do that. All right. So let's talk about this. So everything really started to deteriorate up here, right? At the peak around November. And what happened in November? Well, November, we hit all-time highs, not just for Tesla, but we had highs for a lot of different companies. The S&P 500 was roaring, the Dow, NASDAQ, everything was just booming, all right? It seemed like it was really good times. Now, in the background, we had some other things happening, okay? We had all the stuff with COVID, with Delta, with Omicron, all that stuff was building up. And we had really the big struggle in nature that we're still trying to go through is the supply chains, this turning on and turning off. And then we get behind with supply so that yet the demand's there. So when we get behind with supply and demand's there, what happens? Well, prices go up, inflation starts to creep up higher and higher. And pretty much in November, really in December, is where things really start to take a turn. All right. So this is where the Fed transitioned from, this is just transitory, we just have to work our way through it, to all of a sudden it's no longer transitory. So this is kind of the area of when that happened. And so you can see what happened. From there, we just essentially declined. All right. So then we get into, call this, January timeframe. And this is where we opened up. We jumped up to 1,200. Tesla had amazing Q4 delivery numbers. And then from there, we just sank, right? It was just awful. And then we tried to recover a little bit. And then what do we get? Well, we get Russia invading Ukraine, and that kills it. Oh, and don't forget, somewhere along here, we also get Elon buying Twitter. So that means he has to sell Tesla shares to buy Twitter, right? All that going on. And so we've essentially just been on a downturn, right? And then you get rate hikes, and that starts to kick in, and tapering, all that. And so we just keep getting hammered. All right. So this was all the way up until, call it June, right? If you guys recall, throughout this whole time, I talked about the idea that I thought we were in a recession all the way back. I think it was first week of February. If you remember my ice cream, experience. For those of you who don't know, I went to the grocery store. Ice cream was like $7.50 for a little itty bitty thing of ice cream, and I was like, I don't care if I can afford it. That's ridiculous. I feel like I'm getting robbed by the grocery store, and I walked out. And that's when I was sitting there thinking, okay, this is a problem. When people that I know who, are doing well, and people like myself who, I'm financially independent, but I'm also still, employed as an engineer. When we're making cutbacks on things, well, that's when you know that inflation is really here. And on top of that, perhaps we're going to be in the midst of a recession, right? So that's when I, first hypothesized that. And again, Elon called it a year prior. So, kudos to him. But anyway, so that's around the time where all of this happened, right? And so we just saw everything get beat up. And again, I was saying that I think the second half of the year is when we would rally and recover, right? There are many reasons to think that. First of all, we have never had, maybe not never, I don't know all the history behind it, and at least it's not right in front of me, so I don't want to say something that's incorrect, but historically, whenever we start off the year in the first 6 months with a more than 20% decline in the market, we tend to recover very drastically and hard in the second half. So that's one reason why I was optimistic about the second half. The other reason was because a lot of the Tesla pain here came from, potentially the Twitter deal, came from all the rate hikes going on, came from zero COVID lockdowns for Giga Shanghai, came from delays on Austin and Berlin opening up. You can go on and on, right? I could spend a whole hour just talking about all the things that happened in the first half. But the point was that this wasn't going to last. And it was very obvious it wasn't going to last, right? We were going to go into a second half with essentially all of these, 5, 10, 12 different black swan events gone, all right? Or at least they'd been around long enough where, we just dealt with it, okay? It's old news, and I hate to sound so cold about it, but like when you look at Ukraine and Russia, the conflict there, you don't even see the mainstream media talking about it that much anymore, right? When you talk about zero COVID, it's still a thing in China, but it's just not, it seems like they're not really enforcing it as hard as they were, knock on wood, of course. So anyway, so all of that stuff I knew wasn't going to be continuing into the second half, or at least the likelihood was very low. So that was a lot of the reason why I thought that we would rally in the second half. And on top of that, all this selling, you got to realize this is all coming from someone or some people or institutions. And so there's a certain point where there's only so much selling you can have before you realize how cheap Tesla really is in comparison to its peers, in comparison to any other tech company, right? The way they're printing their margins, their growth, the CAGR, right? It's just insane. So all of those reasons really start to point towards the second half. Now, let's zoom in here, okay? So here's where, I don't want to move any of these around. I just want to move my screen. Okay, so here's where we really start to see some interesting things, where I started to really believe that we were going to move up in a meaningful way. And so let me explain to you what was my rationale. And I'm essentially consolidating every YouTube video I made over the past couple months into this next few statements. So as we were consolidating here, we didn't know we were consolidating, right? We hit this bottom here of 624. Hopefully that is a bottom. And we bounced up, and then we came back down here, right? And this is where we were all fearful. We were all fearful, we're going to go even lower. But no, we didn't. We came back up, but then we hit this line again, and we came back down. And you could see that we were oscillating with higher lows and lower highs. And so this created this kind of symmetrical wedge, if you will. And so what happens is, and this is, look, I'm not a big chart person. I just use it to look at patterns, and it's just kind of fun. But what we knew was we were essentially coiling up at the right time, at the right place. What do I mean by that? Well, all this coiling happened, which again, at first we didn't know this was happening, but as we kind of got coiled with higher lows and lower highs, we knew it was happening, but it was all coming to the precipice of a couple of things. One, Tesla Q2 earnings. 2, the Fed meeting that we just had with the rate hikes. And then 3, whether or not we were going to get a negative GDP for the second quarter in a row. In other words, a recession, despite what everybody's saying all of a sudden over the last week, okay? I didn't realize that we could just change definitions overnight or over a week. But I guess when you're going into a midterm election, or I guess when, the Fed has nothing else they can do, or Janet Yellen is just, I don't know what's her deal. I guess you can just change definitions. But we'll talk about that more in a second here. So we saw all this back and forth here, and it came at this point. Now, a lot of people thought that Q2 would be bad for Tesla, and so that this wedge was going to send Tesla down to the 400s potentially. Well, I didn't quite feel that way. I knew it wasn't going to be a good quarter in the sense of record deliveries or anything of that nature. But what I did know is, one, anytime the consensus thinks something's going to happen, the opposite tends to happen. But two, I did know that Elon and his team could say a few things that would send the stock up. And again, I've said this over and over in so many videos. What were those things? I said that they had to reinforce the fact that they think that they can continue to move forward at a 50% year over year growth, and that that's still intact for this year potentially. I talked about FSD news. I talked about the 4680 battery news, right? And literally everything that they had to say, they said it. And not just did they say it, but they talked about how they're going to grow, how June was such a beast of a month for them that it was the best ever, right? The most they ever produced in a month. So that quarter left them in a very good positive way, and that's where you saw this run up right here. All right, so this run up broke out of that wedge, right? You can almost see a gap here, but it broke this wedge. It broke this resistance that we'd been hitting on once, 2, 3 times, and then this 4th time we just broke right past it. This line here, we can really just get rid of it. I was just using that for the top of this wick, so let me actually just go ahead and delete that. Okay, and then what happened? Well, then we come down here, and then what happens? Well, the Fed comes out, and I told you guys this. I told you that we would rally on the backs of a 75 point basis, a 75 basis point rate hike. In other words, 0.75%. And I also told you that if we get a second quarter of negative GDP, we would rally. What happened? We rallied. Okay. So now we know how we got here. All right. Now, why was I so convinced that if we got a second negative GDP, we would rally? Well, this is where some of the drama comes in, okay? The drama is technically based on 99% of the people who believe what the definition of a recession is. 2 consecutive negative GDPs equate to a recession. Now, over the last week, you saw the White House try to get out ahead of this. You saw Janet Yellen try to get out ahead of this. You saw all the mainstream media sit there and talk about what is and what isn't a recession. And their whole reason for saying we're not in a recession, the whole reason is because we have a strong labor market. But here's my rebuttal to that. 1, for the last 10, actually going all the way back to World War II, every time we've had 2 consecutive negative GDPs, it has always been a recession. 10 out of 10 times. All right. So you're telling me this time it won't be? Okay. Maybe you're right. But here's the other point. Their argument is that with a strong job market, you can't have a recession. This I don't really agree with. Now, first of all, the reason I don't agree with it is because the inverse was true. Apparently, all right, during the Obama years, we had very good growth, but we had very, very weak job gains. So we had a recovery without any real job gains, right? It was very abysmal, to be honest. Okay, so why can't the inverse be true? Why can't we have a recession with strong employment? If one's possible, then the other one's possible. A yin has a yang, right? A call has a put, right? A stock has a short. Like, there's always that balance. Now, the other reason why I kind of don't really buy into the whole jobs part of it is because I think these job openings are inflated. I think they're out there to be out there. I think they're out there to show strength. And I don't think companies are really trying to employ all these people. I'm not saying that there aren't openings out there. Sure, there are. But I think what we really have is not a jobs issue. I think we have a talent issue. And I think a lot of companies just have open recs to have open recs. I think that, I think this whole 2-to-1 ratio that they're talking about, we have 2 times the amount of people who aren't employed or we have twice as many job openings, to what we have people out there to be employed. But the problem is these people aren't qualified or they don't want to go to work. And it's just a very misleading indicator. The last point I'll make on this is, let's assume, forget about the whole term recession. Let's forget about it. What's undeniable is that we are in a slowdown. That's undeniable. Walmart, Target building inventories, all right? You see just about every tech company, including Tesla, with layoffs and hiring freezes. It is undeniable we are in a slowdown. A lot of this is due to inflation, right? As prices go higher, well, less and less people can afford it, and people are starting to say, well, you know what, screw that, I'll save my money, or I won't spend so much money on this, or I have to pay this amount at the grocery store, I have to pay for gas, so what else am I going to do, right? I don't have any more money to spend on these other things. Sure, I could go into credit card debt, which is a whole nother episode, a whole nother ball of wax to deal with, but the point is, we are in a slowdown. Okay, so I know that took some time, and I know that took a lot to get here, right? That was almost 20 minutes just to get here. But so what's next? What's going to happen in the next week, in the next month, in the next part of the year, right? In the rest of the year. So we saw this rally here, okay? In my opinion, I think there's a good chance we continue to rally. I'm going to stop sharing my screen because we don't need that anymore. I believe that there's a good chance that we continue to rally, and mainly because we have the potential for a stock split, okay, a 3-for-1 stock split. And I don't even want to say potential because I think it's a very, very high likelihood that we do have a stock split. Now, with this stock split, I can see a lot of euphemism going into the stock market, right? We might also get investor grade for Tesla. That might also buoy the stock up. But I think I'm guessing. I don't actually know, okay? This is me technically trying to time the market to put more money into it. But I believe that after we split, there's a chance that we see a dip. And why do I think that? Honestly, it is this binary. It is this simple of a thought. There's nothing else to it. It happened last time. Last time we split, the stock rallied beforehand and rallied a little bit after. Then we dipped pretty hard, and then we recovered again. So my guess is, well, if there's a chance of that happening, which there's always a chance, maybe I'll wait to buy more until after we see the split. Now, there's other stuff that could happen too along the way, right? Elon has October 17th is when the trial starts for Twitter. Who knows? October might be a bad month for Tesla. But my whole point right now is I have some cash still, right? And I don't want to deploy everything until I feel we're in a good footing. I would rather spend more money to buy Tesla stock than be fearful about, going back down to the 500, 400s. Now, the reason I'm saving a lot of cash on the side is because I do have options. And so I want to make sure I'm going to be in a good place and I can cover if I need to. Right now, I'm fine. But if we could feel that we're in a better place over the next, say month or even a couple of weeks, I'll probably start buying some more, accumulating some more, and get, kind of dwindling down my cash pile. So that's what I plan on doing moving forward. Now, I also think that we're in a recession, but I think the recession may be over already. Okay, yeah, isn't that crazy? The recession nobody wants to talk about, this recession that everybody says isn't here, I'm saying might be over. Well, why do I think that? Well, I think that because we've seen companies trim down the fat. We're seeing supply chains come back. We're seeing demand dwindle. We're seeing companies get more lean. We're seeing this become a stock pickers market, right? Notice what companies are doing well in the stock market. Apple, Amazon, Tesla, Microsoft. What stocks are doing bad? Zoom, Roku, right? Peloton, all these other, Snapchat, Facebook, right? These companies that were just dependent on ads, these companies that were just dependent on hype and the potential and just let's put money into every great idea. They're the ones that are hurting. So I think we've leaned out. We've kind of shaken out a lot of the wasteful money, the stupid money in the market. I think companies have trimmed fat. I think companies are leaner. And I think companies are going to the second half a lot stronger. And we've destroyed enough demand, I believe, in order to let supply chains catch up. Because at the end of the day, it doesn't really matter if there's a lot of demand as long as supply chains can keep up with it, because that's what prevents us from having inflation. Now, let's talk about inflation. Let's talk about Jerome Powell. Jerome Powell, I think, threaded the needle on this brilliantly. He said enough to make the hawkish people hawkish. He said enough to make the dovish people dovish. He said enough to make the mainstream media annoyed and say that he didn't answer any questions. Jerome Powell threaded this needle perfectly. He gave everybody what they wanted to hear. And the stock market essentially rewarded him for that. So, in my opinion, the reason this was brilliant is because this gives Jerome Powell time. He needs time to see what's happening with the markets. Look, believe it or not, all these interest rate hikes probably have not had a single effect yet on the actual economy. The only effects it's had is on the stock market, because the stock market reacts like this. Interest rates take time to work its way through the market. So if we can have August and into September, we'll get July numbers and we'll get August numbers, and we'll be able to see if we're actually slowing down. Now, if we are slowing down, what that means is perhaps Jerome Powell can slow down his rate hikes. Perhaps that means instead of a 75 basis point in September, which I still think we'll do, maybe he does a 50. Maybe that means the next month is a 25. Maybe he does a couple 50s and then a couple 25s. Who knows? The point is, Jerome Powell essentially signaled that it's time to pivot. Pivot doesn't mean that we're going to stop raising rates. What it means is that maybe now we can take it more gradually. Maybe we do one more 75 and then we start to taper it down as we see the economy start to slow down. All right. Again, it takes time, right? He hasn't really seen the effects of these interest rate hikes. None of us have. And he doesn't want to overcorrect and then send us into a real deep recession or in a real, depressed demand environment where supply chains recover even more so. We have an inventory glut by all these companies. That would not be good. So my prediction for Tesla moving forward, I think it's still going to be rocky, but I think it's going to be rocky on the way up. I think Tesla has essentially shaken everything out. Tesla's going to have a massive Q3, and Q4 is going to make Q3 look like a joke. Tesla is doing a lot of work with FSD beta. 10.13 seems to be very promising, just on what I've seen with Chuck Cook putting out some of his videos, the unprotected left-hand turns with the ADAS drivers from Tesla. Right, those look pretty promising, assuming that it's the ADAS doing those unprotected left-hand turns. We don't actually know if it's them or if it's the ADAS or if it's the humans driving the vehicle. But the point is, it's promising, and Elon still seems very confident about wide release by the end of the year. We have AI Day Part 2, right? So there's a lot of positive catalysts moving forward. But what's negative? Well, to me, the only negative I'm seeing right now is the Twitter issue. Hopefully, Elon can get away with this with paying a fine or a fee or a walk away, $2 billion, if you will, from Twitter. Who knows? Hopefully that's what happens. But the reason I still think this could be a overhang is because if Elon's forced to buy it, he may have to sell some shares. He may be able to just go to the debt market. Who knows how he would want to go about this? But stock market doesn't like that. Stock market likes certainty. And the whole Elon situation isn't certain. So I see more volatility coming into the markets around that time frame, around that decision. So keep an eye out for that. But other than that, I see everything going up and to the right. I believe we are now out of this recession. Right as everybody thinks we're in a recession, I think we're out of it. And the other key signal to this is that Q1 GDP was negative, right? Q2 GDP was negative, but it was less negative than Q1. So to me, it really seems like we're getting out of the recession now. We had the recession. Companies are leaning out. Companies are stronger. Everybody is tightening their belts, right? Every person is. We're spending less. Supply chains are catching up. Like it just feels like this is a good time. It just I don't know. There's something that to me seems like we're just at the precipice of a tilt of some type of change. So those are my thoughts, okay? I know this is a longer video. We're approaching 30 minutes now. I think we're approaching 30 minutes. But remember, none of this is financial advice. This is my opinion. This is how I'm seeing the world. Look, at the end of the day, I listen to everybody. I listen to people like Tom Nash. I listen to Yashu, Farzad, Rob Maurer, Stephen Mark Ryan. I also listen to the Jim Cramers of the world. I listen to Squawk Box every morning, Joe and Ross and all of them, Andrew Ross Orkin. I listen to Fast Money, right? I try to get all of these different perspectives about what's going on. And then I just make my own opinion about everything. Right? Like, I think that's all we can really do. And we got to see what's true for us. Because I take what everybody's saying and now look at my world. All right. I mean, I know I keep going back to this ice cream analogy, but it was real. And that was my real world. With Tesla, just look around. I see Teslas everywhere. This is a no-brainer. They're selling more and more. It's very obvious. And that's just how I feel about all my investments, right? All my best investments, whether it's Apple, that was a no-brainer. It was you go to any mall right now, walk by an Apple store, and you tell me it's not packed. In fact, I'm recording this on my brand new MacBook Pro with the M1 Pro chip. Very excited to see how this edits and see how fast I can download and upload this. So I'll let you guys know how that goes. But the point is, I think investing is a lot simpler than people think it is. I know I like to show the charts and all that, but it's just fun, right? Like when you're really into a company, it's fun to just look at it and see what's happening. But at the end of the day, it comes down to the fundamentals. Does the company have a product that is leading in its space, in its marketplace? Is it a revolutionary product or is it a Me Too product? All right. Do they have good customer feedback? Are they profitable? Do you want to buy one? If you don't want to buy it, why would anyone else want to buy it? All right. My biggest investments ever, Apple. Loved Apple since I was a little kid. I loved my iPod. Loved it. Amazon. Are you kidding me? I used AWS whenever I was starting up a little company with me and a few friends from Annapolis. We started up a company. We used AWS for everything. I have Amazon Prime. I use Amazon for literally every single thing I buy is pretty much Amazon. And then Tesla. I don't even need to tell you guys about it, but obviously Tesla's amazing. And I think Tesla's going to be the most revolutionary out of all these companies. So none of this is rocket science, right? Like you just have to look around the world, listen to everybody, distill it for yourself, and make your own decisions. All right. So we'll leave it there. You can probably tell I'm pretty passionate about these things. I could talk on and on about this. I think that we make too much of what it is to be investing. And sometimes when you take a step back and just make it a lot simpler, right? Find the things that delight you. Find the things that are really well made. Find the things that you see mass people wanting to adopt. And those are the places where I tend to put my money into. They all just happen to be tech companies. And I'm an engineer. I'm in the tech world. So it just, it all kind of works together. So those are my methods. That's what I do. And hopefully this isn't just a rant, but at the end of the day, it's all right because this whole point of this YouTube channel is for my future kids. So hopefully they stumble upon this one day and they see it and they're like, oh, this is what dad did. Okay, well, let's see what dad did and let's iterate on that and let's be even better than what dad was. At least that's my idea for what this is and what this could mean in the bigger scheme of things. And if it helps at least one person out there to look at things in a different perspective, then it was worth it. All right. Well, I'm going to start getting emotional over here. So that's my Saturday wrap up of what I think is going to happen next week. So let me know down below in the comments what your thoughts are. Do you agree with me? Do you disagree with me? Let me know why. Okay. Be positive and constructive about it. Don't just be, a dick about it, but give good reasons if you disagree with me. I'm open to listen to everything. Like I said, I listen to everyone. I listen to Jim Cramer, even though I disagree with half the stuff he says. So, all right, I'm going to actually end it here. Do me a favor. If you want to help the channel grow, hit the like button, hit the subscribe button, or ring that bell. Love you all. Peace.